No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. I've got a great show on for you today. We're going to be talking about investing. And this is one of the things, whether you're investing, it doesn't matter at what age, understanding how investing works and understanding the biggest determinant of what investment returns you're going to get from your portfolio. It isn't about stock picking. It isn't about market timing. It isn't about money managers or which mutual fund you own. It's about asset allocation. All right, and I'm going to explain exactly how that works and the importance of diversification this morning with you. Here's one of the things that we're going to get into: separating myths from truth. There are a lot of myths out there. There are a lot of things that have become, when you say something, you've heard this maybe before, when you say something often enough, people accept it as the truth. Well, I'm going to separate those myths out and show you the real truth of investing, the academic research that goes back over 50 years that we have available today to help us in investing. And I'm going to share my story. I've talked about it before a little bit. When I first started, this is going back 25 plus years ago, my beliefs were the same as many out there with regard to, because I did the same. I got my securities license. I went to work for the broker-dealer that I worked for at the time, and they basically provided me with the types of things I needed to show my clients the mutual funds that were the proven performers, we called them. We'd get a list each month of the top proven performers, and that would be the list of mutual funds that we would present to our clients in setting up their portfolios. Now, what I learned later is I got disappointed because it seemed like the market, the S&P 500 index, which is a broad indicator of the market. This is, of course, the 500 largest companies in the United States. You get to see that ticker, right, each day. They talk about the Dow Jones Industrial Average and of course, the S&P 500 index and NASDAQ, and you get to see how that market shifts. Well, you get to see if it's up, if it's down. If you watch the financial shows and they show the big big board with the S&P 500 index stocks on it, you'll see the green and the red. You know, when the green, the stock is up, and in the red, of course, the stock price is down. Now, the market can be going up, and yet you'll still see red on there, right? Where some companies are losing, their stock price is going down, even though the market as a whole is going up. And the same thing can happen. The market can be going down, and yet you'll still see stocks that are going up. All right, and what we're going to show you is how that can work to your advantage, is understanding this and separating these myths. So one of those one of the things to accomplish today is dispel some investing myths so that you understand what's really important when it comes to investing. And when you're looking at that list of options available to you on your investment account, whether it's a 401k or whatever it might be, right, you'll know that list how to pick which ones and why it's important to pick the ones that you pick. And we're going to do that partly by showing you what doesn't work first, okay? So we're going to dispel some investing myths. We're going to share with you, I'm going to share with you the academic story of investing. There are Nobel Prize winning research, as I said, it goes back 40, 50 years, and I'm going to show how that works in the development of and creation and structure of a portfolio. And then, of course, the goal of this is to give you the opportunity to achieve true peace of mind when it comes to investing. You know, this is one of the things when clients come in to see me. What we all want is we want to accomplish certain goals, right? We want to be able to attain and maintain our standard of living and quality of life no matter how long we live. We're worried we don't want to run out of money. So how we invest sometimes can set us up to do just that. Because if we're investing too aggressively or in the wrong things, we stand a greater risk of loss. If we keep the same investment strategy when we retire and we start taking income from our portfolio, it could set us up for the potential of running out of money. So if it's done correctly, though, we can not only make sure that we get the best return with the least amount of risk throughout our investing lifetime. So both when we're investing for retirement, planning for our future, how the investment strategy you employ there may be different than the one you employ when you retire and you start taking income, because volatility becomes even more of an issue. But the other is, isn't it going to be a lot easier to stay invested if we can reduce the volatility. So imagine, for instance, and this is how this is going to work to your advantage. Imagine if we could take you have the same portfolio, the S&P 500 index fund. And this is one of the things I'm going to share with you, some research that's going to show how the S&P 500 index, and I've talked about this many times and I've used different pieces to show you. The S&P 500 index, again, the 500 largest companies in the United States, makes up 70% of the equity in the stock market, outperforms 90%, over 90% of equity mutual funds in the marketplace. In fact, when we look at the numbers, as I'll show you today, you will see, in fact, that the S&P 500 index, for most investors, they would be better just to put their money in that S&P 500 index than in the portfolios they typically have. Now, what is the downside? There's a lot of volatility, and there's a measure for that. It's called standard deviation, and I'm going to share with you how that works, and again, how you can make it your friend as opposed to your enemy. All right, so one of the things about myths, the commonly held, when people say something often enough, right, we tend to think it to be true simply because it's been repeated and maybe not challenged. So today I'm going to challenge some of these myths with you. So what is a myth? It's basically something that's just made up, right? To explain some phenomenon beyond the science of the day. Well, actually there is science. So first, some of the common investing myths. One, stock selection, that somehow you can beat the market. So we believe that these concepts have been accepted because they've been promoted by the mutual fund industry to a great degree. The second myth, that of track record investing, that you can go out and look at who's done the best, which mutual funds have done the best in the past. So when you're looking at your 401k options, for instance, you're looking at which ones 1 year, 3 year, 5 year, 10-year returns, and you're looking for the best ones out of a particular grouping, whether it's large caps, small caps, bonds, whichever it is. That's how we select. However, that's a myth in terms of their ability to repeat that performance. The myth 3, market timing, that somehow being able to time the market, whether it's getting in and out of the market altogether, whether it's switching more to stocks or bonds at a given time, or maybe even what stocks you own, whether you have more, if internationals are down, you're thinking, oh, I don't want to get into internationals, they're doing terrible, let me just move all my money over into domestic. And then all of a sudden internationals take off and you've missed that boat. We've seen that time and time again, and this is why, again, understanding market timing and asset allocation is so important. The cost of investing. This is another myth that's put out there, that costs are not as important, especially in the mutual fund industry. You're hiring a money manager, and that money manager is saying, look, I can overcome what you're going to pay me, what your costs are, by investing with me. I can beat the market and make up for that cost. That's a myth, number one. Number two, and I'll show you the academic research that proves that. The other thing is understanding, when it comes to costs, understanding that there are hidden costs that you may not even be aware of, and how to determine what the costs actually are in your portfolio. All right, so those are the things we're going to cover this morning. I'm going to get into the myths, then I'm going to share with you the truth of investing. Asset allocation is the biggest determinant when it comes to how much return you're going to get from your investment portfolio, and I'm going to show you how to do asset allocation right. All right, but first we're going to launch into the myths, then we're going to cover those so you understand the kinds of things that can trip you up and create problems for you in your portfolio. All right, so we got a lot to cover today. Stay with us. We'll be right back. Quick break. Join us here. We'll be right back on the Retirement Report.